Hi. There's been lots of worry over the taper in recent days. Now, taper is the Fed scaling back its bond purchases. The concerns are misplaced. Bond purchases are intended to lower interest rates for some maturities, but interest rate adjustments are, at best, neutral for the economy. For every debtor, there's a creditor, and for every person who saves, there's someone who spends more than his or her income. That's just how it is. So interest rate adjustments only redistribute income around the economy. If rates are low or falling, then people who have debts effectively see an income boost because it takes less of their income to service those debts. On the other hand, savers see an income decline as they're earning lower interest rates. And vice versa. When rates rise, savers get the benefit and debtors take the hit. So interest rate fluctuations or changes in interest rates by the central bank really have little effect overall. One segment gains while the other segment loses. And by the way, you could see this pretty clearly at work in the economy. From the early 1950s until 1980, rates were steadily rising and economic growth was fluctuating, with some peaks in growth hitting as high as 8% year over year. Then from 1980 until now, rates have been basically falling to historic lows, I might add, and economic growth has been trending down, getting weaker and weaker. So where's the benefit? Where's the stimulus? If there's any correlation at all, it almost looks like lower rates cause the economy to get weaker. And if you think about it, that makes sense because you're removing income. Same thing with the Fed's quantitative easing strategy. The bond buying removes $1 denominated asset, the bond, and it replaces it with a reserve balance or cash. The total dollar denominated net worth of the public has not changed, all else being equal. You have less bonds and more cash. That's it. Your total amount of dollar financial assets did not increase one iota. You don't have more money. No money was printed. On the other hand, if the government gives you a check, you have more money. You're richer. But if the Fed buys your bond, you have the same amount of money, only in a different form. And by the way, if you think bonds are a burden to be paid for by future generations, then I'll gladly take all the bonds you want to give me. In addition, those reserves that pile up in the banking system don't lead to an explosion in bank lending either, as reserves are not lent out. They just sit there and they're used for clearing purposes. You can also see that there is no correlation between reserves and lending. And while we're at it, the Fed can't create any inflation through monetary policy either, by reasons I just stated. It can change the composition of the financial assets the public holds, give you dollars in different forms, but it can't add to the overall amount of dollars. The government could do this, but if it's cutting spending and shrinking its deficit or running surpluses, it's not printing money, it's unprinting money. So all this worry over taper is just dumb. Yeah, maybe it'll cause some people to shift around their portfolios and sell stocks, but go ahead, let them do it. Once that portfolio shifting has run its course, the market will come right back because nothing fundamental has changed. It's the old story, a fool and his money. Anyway, that's it for now. This is Mike Norman saying see you next time. Bye-bye.